Okay, so we have a little aside before we move into the kind of main course, into our equity area, and a brief look at the emerging markets in terms of bonds. We do see, whenever I think about emerging markets in CFA level 3, again I like to draw the famous negative skew. Negative skew where, watch out, beware the tail, beware event risk. The negative skew, remember, has a low frequency. Yeah, this low frequency here, high impact event. And that low frequency, high impact event isn't going to happen all that often, but what we're talking about with emerging markets, whether they could be political, whether they could be some kind of a crisis or contagion that can come in. And we do see quite a lot of reference to the famous carry trade, which is coming. Guys, later in the chapter, the carry trade, the idea being that you invest in an emerging market while things are quiet and calm. So where you'll see the carry trade, guys, in level 3, you'll see it in the currency area. And that comes in the asset allocation part. You'll see that coming later on. So this idea of unstable or watch out for things changing, watch out for that negative skew. They liken it to picking up small profits. So in the good times you pick up small profits. They liken it in front of a steamroller, watch out for things suddenly changing. By the way, they also think about the two main aspects of ability to pay. What's their ability to pay and their willingness to pay? Now, this is from a political perspective, and from a credit risk point of view, we often think about ability and willingness to pay in many contexts, perhaps for a mortgage or a loan. But here, from a political perspective, can the country pay? Now, this material has been around a long time, and I have seen past questions, particularly, of course, in the morning. They publish these in this kind of materials. Have a look at some of these metrics here. So these are some classic warning signs to be aware of. And in the exam, they'd often give you a table of data that you might need to interpret here. So watch out for irresponsible things like big deficits and monetary policies. Guys, if the deficit to GDP ratio there is above 4, again, that's going to be a warning sign. They're not saying that that's an immediate panic, but they're saying to look and beware of this as an issue to look a bit further into. Now, in the emerging market area, you would expect high growth, of course, but if the growth wasn't that great, then are they kind of catching up? Have they caught up? Are they catching up to the advanced economies quite quickly? You'd expect growth to be higher than 4. One other one that's not mentioned here that I thought was worth a mention is mentioned in the text: the debt to GDP ratio. And a warning sign for emerging markets is quite surprising, but 70 to 80%, which is of concern if it is an emerging market. Now, in real life, we know that many countries, the UK as well, of course, has quite a high debt to GDP ratio. That's okay for a developed market. Developed market is okay. Emerging market, they're saying here, is a problem. Okay, so when you think again about some of these metrics, there's been quite a few references to financing from foreign borrowing, thinking about the deficit problems here, where we have a budget and a current account deficit, that we're using foreign borrowing to buy our imports in this way. And guys, if you have the current account deficit higher than 4% of GDP as a warning sign as well. Having to pay foreign denominated debts, if you can print your own money, it's easier, but having foreign denominated debt, you can't print that. You have to get hold of that. So do you have enough? Do you have enough debt? Do you have too much debt to GDP? Guys, your debt to GDP, if it's above 50%, that's going to be a warning as well. And finally, they mention one more here. Have you got enough short-term liquidity to service this foreign debt? And they quantify that as your reserves, your foreign currency reserves. You have enough to service that short-term foreign currency debt. And I guess the politics of things as well. It's the politics of things as well when you think about what's going on. Again, I can't help thinking about the UK, not so much an emerging market, but certainly have the same problem here, this risky current situation, uncertainty about our Brexit. But from an emerging market perspective, you can see the same kind of problems here. The context for the chapter, they do talk about Latin America, talk about Mexico and Asia and also Russian previous crises, guys, as a backdrop to this chapter as well too.